All right. Well, good afternoon, Joe. How are you?
I'm good, Mike. How are you?
Good. So welcome, everybody, to another edition of the Mortgage Update with Mike and Joe. We did miss last month, so we do intend to.
We did. We couldn't get through security to get into Bill's camp.
This is true.
We had to postpone the podcast. However, we're back.
We are back, and we're. And with that being said, it's great to see that at least for 1 week the Bills are back.
The Bills are back, and I just want to take everybody back. We've been doing this a little bit over a year now, right? So last year when we predicted the season, I don't know if you remember, but you went Bills 13-3.
I nailed it.
You nailed it.
Yeah.
But in reality, you missed a game.
Right.
But so did the Bills.
Correct.
Right? So we're back at it. I think we're going to change it up this year, right? We're going to go week by week predictions as opposed to all in.
Right.
Right. So we had the flopper against the Jets.
Right.
Came back strong against the Raiders. And then this week we go down to Washington to play the Commanders, who are 2-0.
Right.
Coming off of wins against the Cardinals and the Broncos.
I am predicting a win. And I think, and the reason why I say that is I think that the Bills, the coaching staff, particularly Josh, I think learned their lesson from week one and are really going to kind of keep the game plan simple, straightforward, play good defense. If they can just do the basics well, I think they're going to come away with a win.
Right. And you'll notice I don't have the hat on today, but they'll be coming back.
Okay,
so
good.
it will be coming back strong.
Good. So excited about that. It really does seem like the Bills are back on track. But as you said, we'll take it 1 week at a time. So obviously, Joe, let's talk about the market. Obviously we're moving into the fall. We know that rates have been stable for the most part. They haven't moved up much. They haven't, moved down much. But in regards to just the market, we're still seeing inventory that is still low, steady but low. Can you share with everybody that's listening in kind of what the market looked like last month and what we learned from that?
Yeah, I mean, August data has been a lot of the same of what we've seen, over the course of the year in Monroe and surrounding counties. A number that stuck out to me was 98% of the homes that we tracked went over list price. Now, some were as low as 1% over list,
sure,
up to as high as 48% over list.
Right.
And so those were, we would continue to see that, that low list, high sale price. When we break the numbers down, 7% of those homes were 30% or more. 22% were 20% or more over list, right? So again, still in that 20 to 30% range. And then there's a chunk that are in that, 1 to 20% range going over list. One of the hottest zip codes for the month was the 14624, which averaged 47.5% over list. But one of our zip codes in Monroe County actually made a state or countrywide hottest list, and that was Pittsford. They were the named the ninth hottest zip code in the country for time on the market,
right,
as well as homes percentage over list and desire.
Now, Joe, with as many of these homes continuing, to continue to go above the list, what did we see in regards to appraised values? Were appraisals coming in lower, or what do we see? Yeah,
we did have a few. We had 4 homes that came in undervalued, and I think a lot of times, again, as we've talked about on this podcast, is preparing your buyer for that potentially happening when you're writing or preparing that offer by having one of our loan officers vet out that appraised value up front, so we get an idea of what we're dealing with. I will say that there's times where we vet it out up front, and it comes in. The appraiser looks at it initially and says, "Hey, I don't know if there's some sales there, but it looks like we're coming in here." And then they write a little bit higher and it still ends up coming in at value. So, that just helps to prepare for the worst case scenario of, okay, if it did come in here, here's how we can adjust. Here's how we can use the appraisal gap solution to make up that difference and really close that appraisal gap.
Okay.
So if we go down the throughway to our friends in Onondaga County, again, same as what we've been seeing all year, much different story. The market there is a lot flatter. On average, in Monroe County, we saw 14.7% over list. In Onondaga County, we saw 2.7. So not as much. You're looking at a little bit around 50% or so going over list and 50% under. So or at or under list. So, we're not seeing a lot of, hey, this house went 20 grand less than what the original price was. But we are seeing, some of that, from conversations I've been having. We had the Labor Day holiday here a couple weeks ago. So we're seeing a little bit of a shift in the market, which is normal for this time of year. Kids getting back to school, people focusing on other things, sports. I know I've been running around to different soccer fields all month. So there's a lot going on that kind of distracts people from home buying at this time of year. And usually we see a little bit of uptick towards second half of September, beginning of October. And then, really we're winding down the year for closing transactions, because again, if you get into contract and something in November, you may get that house closed by the end of the year. You may not.
Right. I think this is also I know we say this on each podcast, but, for, the folks that work here at GRB, the realtors that we work with, just making certain that all of those buyers that we've worked with throughout the entire year, perhaps even last year, that have not been fortunate enough to win an offer, is to continue to go back to those people, make sure that they're pre-approved to go through our Cash Plus program, to make certain that they're ready to buy. Because, again, we are beginning to see some transactions or houses being on the market a little bit longer.
Right. Going past delayed negotiations is becoming more common. And then it's a scramble to find, that house that had 10 buyers interested in it before has 2, right? And it takes 2 to tango. But if there's not those 2, that house becomes open game. And, you could be that one lucky winner that's able to, you decided to write on this house and nobody else wrote, and you get it for what you thought the price was. Right. So there's a lot going on there. But you did mention pre-approval. So, if you recall in the last episode, we introduced the GRB Power Tools. We talked about walking around the house with tool belts on. But what that is what are those tools that when we have our buyers, how can we give them an advantage? And because we did miss last month's episode, we're going to talk about 2 power tools today. The first one is the pre-approval. Right.
So Joe, let's kind of pause for just a minute, because one of the things we want to remind everybody about is just, we have this YouTube channel, and we encourage everybody to go to it. You can watch past podcast, and you can watch it for a few minutes, or again, go back and look at some of these power tools. And I think you talked about, last time we had the podcast, that, the GRB Mobile Express app. And just to remind everyone, particularly the agents, what is the benefit of that app as it relates? And then we'll certainly talk about the pre-approval as well.
Sure. Yeah, and the app, again, it has a calculator, a built-in calculator, so people can calculate their payments, what their cash to close is, et cetera. It can be shared, so you can partner with one of our loan officers and share that app directly with the borrower, so that they can apply online while they're sitting in front of you. Right. This way, that initial phone call with a loan officer is a lot more impactful, because they've had a chance to review that information, because the borrower's already filled out that application. And it also gives us a little bit of tracking on the borrower, right? If we were talking to a borrower today and it's January, we've shared the app, they've downloaded it, and then they kind of disappear for a little while because they, got out of the market or it was too hot. And then they reopen that app again in July. Now we get notified, hey, this person opened the app again. We can reach out and have some communication, some dialogue around what's going on there. So great benefit for that. But today's power tool, we're going to focus on the pre-approval and the DSCR loan, which we'll talk about in a moment.
So, Joe, with the pre-approval program, so let's talk about, why did we roll this out in the first place? Who is it intended for? How does it work? And how does it help the agent and the buyer put themselves in a much more competitive position to win an offer?
Yep. So our pre-approval program is similar to our Cash Plus program in that it's a fully underwritten mortgage commitment. So we're working with that buyer up front to collect all their docs, verify their income, their assets, their credit, make sure everything on the deal is all set, aside from them finding a house, and get an appraisal on that home. And the pre-approval program differs from the Cash Plus in that the borrowers don't need to have a 10% down EMD, right? We require that their earnest money deposit is what they're putting down on the home. So if it's an FHA transaction and they're putting 3.5% down, that's what their earnest money deposit has to be. And we did that purposely to help those borrowers that didn't have the 10 or 20% down to put for these cash programs to give them a little bit more of a level playing field when they're writing offers on these homes. Because again, if you know that the mortgage commitment has been satisfied, that means we've vetted everything out. If it's an FHA borrower, we've checked CAVers, we've checked for student loans, we've checked our fraud tools, we've checked everything to ensure that when we issue that pre-approval, that loan is going to close because the borrower, all the skeletons have come out of the closet. We've addressed them all. That's an early Halloween reference.
Sure,
But,
right. I like that.
we've addressed them all and kind of vetted everything out so that when it comes to closing, and we love those loans because we do all that work up front, they get under contract. We have to get an appraisal and homeowners insurance, and the deal's done.
So Joe, is the buyer getting an actual commitment letter?
They are getting two letters. One of them being our pre-approval letter, and it's highly, it's visible on there that it's a GRB pre-approval, not a pre-qualification. And then they're getting the commitment letter as well, which is available to them to provide with the offer.
Okay.
So all done, all underwritten, buttoned up, and ready to go. And we've seen a good success with that. We've done, quite a few of them, and we're seeing about a 60% conversion, which is much higher than what we see from our standard pre-qual letters, right? That means 60% of those buyers that have gone through that process have gotten under contract.
Right.
And that's anywhere from conventional, FHA. We're doing them on VA, USDA, Sunny Mae. So anybody that can kind of, any other loan product, we're doing these pre-approval.
And this is someone that's with little as 3 to 5% down.
Correct.
Okay.
Yep.
That's great. So Joe, let's talk about this DSCR program. And before we do that, just to introduce this, is that, we already offer kind of a host of different programs for investors, people that are buying investment properties, 1 to 4 unit, and we have a whole range. And I think one of the things that I think is exciting about this particular program, it does have a niche to it. Why don't we kind of start with what does DSCR stand for, and who is it kind of geared towards, and who can benefit from this program?
Yep. So the DSCR stands for Debt Service Coverage Ratio.
Okay.
And that basically looks at.
So what's that mean, Joe?
Yep. Well, you're jumping ahead of me.
Okay.
That looks at, what is the debt service coverage ratio of the home? So what is the gross rent received on the property, and what is that PITI? And you take the gross rent, let's say it's $1,000, and the PITI is $900. This is a cheap property. That means that you have a 1.1 DSCR ratio, meaning your rent is 110% of your PITI.
Okay.
And that's all, right? So that's all that they're looking at. They're looking at assets, right, to make sure you have the money for down payment and it's documented, et cetera. But from a qualifying perspective for a borrower, they don't have to document their income. And what we found is that some of the target audiences are these larger investors that have a ton of investment properties, right? Normally, if you're going through a secondary market transaction, you have to document the PITI on all the properties. You have to send lease agreements and tax returns and everything for, let's say you own 20 properties, you got to provide that for all 20 properties. With the DSCR program, you don't. And you're qualifying just on that rental income of the subject property. And as long as that DSCR ratio exceeds 0.75%, we have some investors that will go down that low, you can qualify for the purchase of the home. Now, it is a 20% down program. There are some seller concessions allowed in the program. So
what about credit score?
Credit scores, you can get as low as 680.
Okay.
But that 700, 720 plus is kind of the sweet spot for the credit score. Now, there are options with this. You can choose to have a prepayment penalty, or you can choose not to. If you do add a prepayment penalty, you get a little bit better rate. That's why it's there. And the programs are wide ranging. I mean, you can have a 30-year fixed. You can hold title in an LLC, right? So again, it's those borrowers that have the cash to put down, but maybe their income they can't document, or if they're self-employed, and the tax returns show a loss, we just get rid of the tax returns. We use the rental income from the property, and that's how we qualify them. Okay. And we've done about 10 of these so far. They've gone smooth. And I think we see it continuing to grow, especially as people are looking to get into that investment community. And we can do them for first-time investors. So this isn't just for the seasoned investor. The seasoned investor is a little bit they do get a little bit better rate, but the first-time investors can get into this program as well. And it really cuts down on the documentation that's needed and the questions that need to be asked when you look at all those different requirements.
Great. And again, it just reminded me, we have a whole host of products for people that are buying investment properties, and I just encourage you to talk to your GRB rep and about this, because there's a whole host of options out there as well. So Joe, let's shift gears. So last time we met, we've gotten feedback that from an education perspective, we wanted to really kind of, on each podcast, give a little bit of just a piece of information that the audience can use. And today we want to talk about or try to debunk some of the myths around down payment. Can you kind of, speak to what some of the myths are and what the actual realities are?
Yeah, I mean, I think, a lot of us deal with that common myth, or, when you talk to misconception about when you talk to somebody about buying a home. Hey, have you thought about buying a home? Well, yeah, but you know what? I really need to save some more money before I do that. Mm-hmm. And then you start to talk about them about, well, did you know that there's 100% financing options mm-hmm. available? Did you know that there's grants available that can help you cover some of your closing costs? And, we take advantage that we eat, sleep, and breathe this business, right? Mm-hmm. This is our world. We live in it constantly, and some of the terms and some of the terminologies and the guidelines, we could recite them in our sleep. And sometimes we lose sight of the fact that unless you're working in this business, you don't know that. And so the down payment question always comes up, and, a lot of people think I need 20% down to buy a home. And the reality is you don't, right? You can do there are programs through Sunny Mae, the State of New York Mortgage Association, that have 100% financing, mm-hmm. USDA, VA loans. If you qualify for those, you can get 100% financing. And then when you get into the conventional, you need 3% down, right? Mm-hmm. You can pay PMI and you can get yourself to a comfortable payment that allows you to still buy a home. And a lot of times, when we look at borrowers that are putting 3% down, they're excited because they're buying a home that allows them to have a mortgage payment that's less than what they're paying for in rent. Mm-hmm. And now they're starting to build equity in that house, and they see, the desire for entry to homeownership is huge. And, some people don't know that those obstacles aren't as big as they think.
Right. That's good information. So Joe, to kind of wrap up the podcast. So, one of the things that we want to do, right? We want to set some goals, right? We want to try to drive as many people to take advantage of what we're sharing. So you kind of want to share with the group kind of what you had in mind?
Yeah. So we've been doing this, like I said earlier, a little bit over a year now. Mm-hmm. And we are up to 54 subscribers on our YouTube channel. Mm-hmm. And our Instagram channel for the bank is about 520 followers. And so I know that you and Tammy were talking about who our audience is for this podcast, right?
Tammy's my wife, by the way. So
yes, your wife, Tammy. Yep. And she said it's just her and her friends, right? She doesn't believe that we have followers. Right, exactly. And so we're on a mission, mm-hmm. right? We're on a mission to grow our subscribers, mm-hmm. and we're on a mission to increase our followers on Instagram, because our marketing department does a great job of pushing out content, mm-hmm. especially on our Instagram, on all our social media channels. So we really want people to be able to benefit from that content. So we're going to have a little fun. Mm-hmm. And we're shooting for, by the time we record our next podcast, which will be about the second or third week of October,
right?
We want to see our subscribers go from 54 to 65. Mm-hmm. And we want to see our Instagram followers go from 520 to 550.
Seems like a reasonable.
That's not a lot of people, right? We could probably do that if we just go around the office and get some of the employees to do it.
Yep.
And then we also want 10 likes on our podcast. Mm-hmm. So we're not asking for a lot, right? And if we do that,
yes,
I have gotten Mr. Pulver himself to agree for the month of October and potentially November and December. We'll set those future goals to come on and do the podcast in costume.
I've been looking forward to it, Joe. I think most people know that I've got a closet full of costumes.
I don't think most people know that.
Well, now they do now. They do
right.
know that. So there's just a couple of highlights. One, obviously as we go into the month of October, Halloween,
Yep.
here we come. I'll certainly, be willing to, break out my Batman,
Love it. The Dark Knight.
Yep, the Dark Knight. Last year, just as an FYI, my wife and I got second place in a Halloween costume contest. She went as Cruella de Vil, and I went dressed up as a Dalmatian.
Okay.
And that was a real big hit. So I would very much, like to do that. And again, I think, we are encouraging people to like the podcast. And I think, and certainly the other thing too, is we want to get feedback from everybody in regards to additional topics
Absolutely.
that they want to have us, talk about. The mortgage finance industry is always changing. It's in a state of flux, and certainly we want to do this so that we're providing some real value, some current content, and things that are going to help realtors, particularly, be more successful in a really challenging environment. So
Yeah. So like and subscribe is
Yep.
the motto,
okay,
right? We got to get those likes up, those followers up, those subscriptions up.
all right, sounds good. All right, go Bills, and we'll see you guys in a month. Thank
All
you.
right. Thank you.